Welcome to another weekly market update. September the 25th is the Sunday after the market closed on the 23rd. Last week I prepared just a quick video on how to read a chart. There were things I'm looking at. So you can see that up on YouTube as well from last week. So if you don't know what I'm talking about, it's all right there, and it's very simple. Let's look at the very big picture. This is, since 1998, just to point out that, markets do go in cycles, and we're certainly at the top of one here, one would think, but that doesn't mean to say the market can't go higher in the face of what is increasingly, not good news coming out of the world economy and various other things, not to mention a tumultuous time ahead in the run-up to the US election. But of course, bear markets do happen. The big question is when. If we zoom in a little bit, and as I was explaining last week, this is a chart of the S&P 500, which is the the biggest stock index. But if I put a chart up of all the stocks in the New York Stock Exchange, and it's a slightly different picture. We're not in that all-time high area. The prices are down here, and one could still argue that this is just like a big rally in what was an ongoing bear market. So it's a tale of two charts, and it depends on which ones you believe. There is a chart of what's called the All-World FTSE All-World Index, and this is basically a chart of planet Earth. It's literally every stock market in the world pushed together like that. And what you can see from that is that again is much like that chart of the New York Composite, all the stock markets blended together. So when you look at it in that context, which is an interesting one, because America, of course, doesn't, and especially not the S&P 500, doesn't operate in a vacuum. It's a global economy. It's become more globalized than ever, actually. And what can affect one country can soon affect another. And this is perhaps a chart that one could look at to see what's really going on out there. So you could argue that the SPX is kind of like doing its own thing, plugging away there in the face of all that bad news, and it seems to be in that sense kind of like almost like its own little bubble there. But that doesn't mean to say it can't go higher. So longer term, as I've been continually saying, I'm bearish on the overall situation with a kind of 6 months to 1 year time scale. But that doesn't mean to say there aren't some playable rallies in the meantime. Here's that weekly chart. We're zooming in a little bit now on the S&P 500. And as I've been pointing out the last couple of weeks now, there's that line of resistance there, the top line of the prices at around 21.20. It broke out and then pulled back and then bounced right off again, which is unarguably healthy action. So this rally is, it's intact. It's in a confirmed uptrend, and when markets break out or like that, pull back, even individual stocks actually, and then this is just called a pullback, and then off they go again. That's healthy action, and you see it in closer up here for the S&P 500 on that 21.20 line. There's that line. And there hasn't been a great deal of conviction behind any of these selling moves. But that is tempered by, as I say, the election season coming up. So the line in the sand, I would say, is 21.20. Anything below that is, could be very troublesome for the market. And it depends on how it's viewed. I think if the market starts to see a Trump victory as being a likely possibility, and right now it doesn't, then it's definitely going to weigh on prices. Hillary Clinton is seen as the status quo, and the market doesn't like uncertainty. So I would say cautiously optimistic in the very short term for the week ahead, and I will speak to you next time.